So as mentioned, I'm Anthony Lynch. I recently joined the management team of the Claverhouse Investment Trust. So myself and Ketan Patel, who've been working together at JPMorgan on our UK Equity Income Fund, have come onto the trust to work with Callum Abbott, who's been managing the fund for the last 6 years, following the retirement of Will Meaden this summer. Now, Claverhouse is essentially an equity income trust, so I accept that's probably not as exciting as the space investment trust you hear about later. It's a more vanilla category, I suppose. But this is a trust that we think has actually got a really exciting history, and we're really excited about the future for it as well, which is one of the key reasons that we've chosen to come and join the management team. You'll be aware that as an equity investment trust, we have one of the key things that we have is our dividend track record. And the Claverhouse Investment Trust is offering a yield at the moment of almost 5%, so a premium to the FTSE All-Share. And the FTSE All-Share itself is then offering a premium to pretty much any other equity market in the world. So in terms of looking for natural income, we think this is a really obvious place to be looking. We also benefit from the ability to gear the trust. So we have a long-term debenture at 3.2%. That means that we're able to invest that money into the equity market, where we're getting a much higher yield, and we expect our earnings to be growing as well, whereas clearly those debt repayments stay constant over time. And at a time where interest rates are falling, we think that this sort of yield from an asset that should be growing over the long term is essentially offering an attractive alternative to cash on deposit, which we know is at elevated levels in the UK at the moment. I touched on this a moment ago, but one of the really, really outstanding things that Claverhouse has delivered over the long term is a strongly growing dividend. So since inception, Claverhouse has grown its dividend every single year for 51 consecutive years, and at a compound growth rate of 9%. And what's really supportive to that is the investment trust structure. So if you run an open-ended fund, and we have a UK equity income fund that's open-ended, if the earnings of that fund and the market go up one year, you pay it all out. If the earnings of the market and the fund go down the next year, you have to pay out less. And so the dividend or the income that the underlying investors receive is quite volatile. In Claverhouse, we have the ability to hold reserves. So by not quite paying everything out every year, holding a little bit back cumulatively over time, we're able to smooth that dividend growth. And at the moment, we've got about 0.7 of a year of dividend in reserves, meaning that if we were to go into a choppier environment, the fund would be able to continue to grow that dividend despite a more difficult backdrop. This has meant that the Claverhouse Investment Trust has earned AIC Dividend Hero status, which is awarded to trusts that have grown their dividends for, I believe, 20 consecutive years, but clearly 51 is quite some way above that. And touching on what I mentioned a moment ago, but you can see here the earnings per share of the FTSE All-Share Index. It generally goes up, but it can go down, and when it goes down quite sharply. So if you think about times like the global financial crisis, the COVID pandemic, or at the end of the commodity cycle, around 2015-16, that end of that commodity super cycle where a lot of the miners were cutting their dividends, these sorts of environments can make it very challenging to carry on returning a growing income stream to investors. But as you see then on the right-hand side, Claverhouse, by using those reserves, has been able to keep growing that dividend, and cumulatively well ahead of inflation, well ahead of the growth that's been delivered from the broader UK equity market as well. Now, as I mentioned, myself and Ketan came to join the fund this summer. And so, look, I've been working with Callum for about 10 or 15 years. I've been working with Ketan for about 10 years as well. So we've got a well-established method of working with each other. And as you'd expect, our process for investing has not changed as a result of this. We all follow the same broad investment process. But what we have done is ever so slightly tweaked the way that we implement that process. So if you're looking for a fund that is going to have a good dividend, but is going to grow that into the future, then what you don't want to be doing is just owning a small group of high-yielding stocks over here, where every year the dividend might be flat, might be down, and then you're going to have to buy some other high yielder to replace it, and then offsetting that with some extreme high growth on the other side. We've gone for a more balanced approach. And so we divide the portfolio between traditional high yielders, but specifically focusing on companies where we're confident that that dividend can continue to grow into the future. After all, a stock that yields 5 or 6% today, if it still yields 5 or 6% in 5 or 10 years' time, that's just not that interesting. I mean, that's not going to help us grow the dividend every year for 51 years. So we're mixing that up with some higher growth companies, but also quality compounders. And by number of stocks in the portfolio, actually the bulk of our investments would be in that quality compounder category. So if I had to talk you through the sorts of companies that would make the cut into these buckets, high yield, there are some obvious names in there. You know, we own a company like Shell, and I'll touch on that in a moment. But that's a company that's got a long established track record. It's had a tricky period for dividend growth, which is why we've been sort of less positive on it in the past. But if you look at Shell today, Shell's yielding 4.5%. That's more than 2 times covered by cash flow. That dividend's still covered at $50 oil, so at a substantially lower oil price than in the current environment. And Shell trades on 8 times price earnings, which compared to ExxonMobil in the US, I probably pronounced it wrong, that stock trades on 15 times earnings. They're very, very similar businesses. It's one of those key examples of where like-for-like stocks are just simply too cheap in the UK. So we think a high-yielding company, a really good example of a business that we think is undervalued. We then also invest in quality compounders. So a quality compounder is a business that's quite capital light, so it doesn't need to, whenever it generates any cash flow, it doesn't need to reinvest that into CapEx. It can just return that cash back to shareholders. And a good example of that would be a company like 4imprint, which I would guess almost nobody in the room has heard of. But if they have, they're probably quite rich, because it's one of the best performing stocks in the UK stock market over many, many years. The business is focused on promotional merchandise into the US. And essentially that means you probably all have some goodie bags. You've probably got a Schroeder pen and somebody else has given you a pad. There might be some AJ Bell stuff in there as well, maybe some mints. Well, all of that stuff would get printed by a company called AJ Bell. Sorry, not AJ Bell. That's you. See, this is why you should always stick to the script. It's done by 4imprint. 4imprint. What's brilliant about 4imprint's business model is they're not making any of the stuff. It's all made in China. It gets shipped over to the US, comes to their warehouse, they assemble it, print the name on it, and ship it out again. And they are leaders in digital marketing. They've really played around with different methods of marketing. They do stuff like give out free boxes of the stuff to businesses that haven't ordered from them before. Whereas all of their competitors pretty much are still literally salespeople getting in the car and knocking on doors. So a real competitive advantage that's led to consistent market share gains over time. So a business that kind of gets underappreciated by the market, has a really attractive dividend yield, returns all of that cash to shareholders with special dividends every few years. Not your traditional income stock necessarily, but the kind of business that doubles its dividend every few years and therefore really underpins that dividend growth for Claverhouse over the long term. And then finally, higher growth companies. And the example we've got here is 3i Group, which has been making some headlines recently after some negative views from one investor, which we aren't particularly bothered by. But the core part of this business is a business called Action Retail. So Action Retail is a Dutch discount retail business. The reason that we like that business is it has grown its EBITDA at a 25% compound rate since 3i invested in it. So this is one of the highest growing retailers that exists. And, importantly, I know it's real because the last time I was in the Netherlands, I went there, I bought some marshmallows. They were very cheap and they were delicious. And 3i, since we invested in this business, its dividend has gone up something like 5-fold. So that's, again, a business that maybe when you initially invest in it is on quite a low dividend yield, 2 or 3%, but that compounding effect of growth means that a few years later, The look-through yield on our original investment there is north of 10%. So again, really underpinning that dividend growth for the future. And so by breaking the portfolio down between higher growth companies, compounders, but also those traditional high yielders, but the ones where we're really comfortable in the dividend and the sustainability of that dividend, we're able to build a portfolio that delivers exactly what Claverhouse has delivered from a dividend growth perspective in the past, carrying that on into the future. So what does this actually mean in terms of the shape of the portfolio? What have we actually done to change it and to sort of implement this process that we're talking about? Well, when we took over the fund, almost 85% of it was invested in the FTSE 100. And the FTSE 100 is, it's an important part of the UK equity market. It will always be the lion's share of where we find dividend opportunities. But we think that by slightly reducing some of those traditional areas of yield, commodities, utilities, tobacco, and investing elsewhere in the UK equity market, we're getting more diversity to our income, which means that if you're less reliant on one source, you're less likely to face a big cut in a single year. It's also meant more breadth by sector. The 10 largest contributors, for example, to income have fallen. And that has meant, ultimately, that we're more confident in those dividend growth prospects going forwards. There have also been some sector changes as a result of this. So on the underweights, and those yellow bars represent sectors that we're underweight relative to our benchmark. So, for example, industrial metals and mining, 3% of the portfolio is invested in them, but that's 2.5% less than the benchmark. Now, metals and mining, it's an interesting area. There are some good companies, there are some bad companies, and there are some truly awful companies. What we're looking for are the good companies where we think that they can actually grow their production, that they're exposed to the right commodities, rather than something plain vanilla like a Rio Tinto that we think actually isn't going to grow its production for the next 5 years, is exposed to iron ore, which is one of the most commoditized commodities, which is saying something, and where the dividend is unlikely to grow for the next 5 years. And actually, we have concerns about capital discipline, not just at that business, but more broadly in that industry. So Rio Tinto and the industry in general went through a phase of misallocating capital horrendously in the mid-2010s. You'll be aware of some of the mega mergers that went on in that time period. We think those sorts of deals are kind of back on the agenda, and that could be at the expense of dividend growth. On the other hand, we're overweight sectors like investment banking and brokerage. And don't worry, that doesn't mean JPMorgan and Merrill Lynch. This is quite a catch-all phrase that's used to cover a lot of businesses. So, for example, 3i sits in that sector. 3i isn't really an investment bank. It's 70% exposed to Action, which is a European retailer. The second biggest holding is a business called Intermediate Capital, which is a fund management business. But importantly, they're focused on alternatives, and they've got a fantastic track record for fundraising. So we've been through an environment over the last couple of years where it's been really difficult to raise funds, and actually their track record for continuing to upsize vintages of funds as they progress, whilst maintaining fees at attractive levels, far more attractive than the Claverhouse, I can promise you, has meant that they have had an excellent track record in this sector. And finally, XPS Pensions, a pension consulting business that's got very strong organic growth, not just from the fact that the pension consulting market is growing strongly, but they're also taking share off the traditional incumbents. And so that business, very capital light, fast growing, it's grown its dividend at a double-digit compound rate. It yields more than the FTSE All-Share, and we expect it to continue growing its dividend at a similar sort of level going forwards. So these are the kinds of opportunities that we're looking for. As you can see, we're also quite positive on some of the UK economy exposed sectors, things like household goods and home construction, so the house builders, the banks, the retailers, and I'll touch on some of that in a moment. We've also got some of the individual stocks. At risk of repeating myself, I won't go into any of the individual names on here because I've covered a few of them already, but if you do have questions, there's obviously a slot at the end if there are any you'd like to ask about. So why are we positive on the UK economy? Because I'm sure you've all heard it's dreadful out there. not just the rain, but the budget, the general malaise that has been going on for quite some time. And casting your mind back, it actually feels like quite a long time ago almost that inflation was 11%. Now it's only 2%. And I know that there's a difference between headline inflation and core inflation, but the fact is, it feels like we're at a very clear turning point in the economic momentum of the UK. And I think those turning points are one of the most important things to look at. Everyone knows America is great, and America's going to be great again, apparently. But trying to continue to surprise people is a difficult thing to do. Whereas in the UK, where expectations are incredibly low and valuations are incredibly low, actually this sort of turning point with inflation rolling over, we think is a very interesting time to be looking at what is clearly a very cheap equity market. You'll all be aware that the Magnificent Seven in the US has had an incredible track record. But you'd probably all be surprised to know that Imperial Brands, formerly Imperial Tobacco, has outperformed the Mag 7 over the last 3 years. When expectations are low and valuations are low, there's a very strong opportunity for strong total financial returns. On the other hand, if you'd bought Microsoft at the top of the TMT bubble back in 2000, it would have taken you 14 years to break even on that investment. So, valuation and economic turning points we think are very, very important to look at. So why is falling inflation important? Well, the UK relies a lot on consumption. We are, a largely consumption-led economy, and one of the biggest drivers of consumption is household real wage growth or household income, household free cash flow. And that's a function of two things, well, three. The first is, do you have a job? But as long as the job's staying, there are two drivers. How much are you getting paid? And what's inflation? And if what you're getting paid is going up by more than inflation, then typically that means you start spending more money. You feel more confident, you're willing to go out and spend on major purchases. Weirdly though, in the UK, despite the fact that we've returned to positive household free cash flow, positive UK real wage growth, we're not spending it, we're still saving. And consumer confidence had been improving, and it's just taken a little bit of a crash ahead of the budget because people are thinking, well, I probably just sit on my cash at the moment because I don't know what's coming. But the facts are, we have accumulated more savings in the UK than pretty much anywhere else relative to the start of the pandemic. We are in a pretty strong jobs market and the economy is improving. And while political noise and macro noise can often get in the way of what should be a good underlying narrative, we like to take a slightly longer term view than that, look through to what is actually going to happen. And what's going to happen is people are going to start spending the pound that is sitting in that pocket when they feel confident about it, and that time will come. And the companies that we think will do really well out of that will be some of the retailers. At the moment, the rain's not helping, the general sort of nervousness around the budget's not helping, but there are pockets, there are individual companies that have track records for taking market share, whatever the weather. And so these are the sorts of companies that we're looking for, the Dunelms, the Jet2s, businesses that we think carry on growing but could just get that growth turbocharged should this economic scenario actually play out. And then finally on the house builders. The house builders trade close to book value. These are cyclically low valuation levels, despite the fact that interest rates are rolling over and the Labour government, if they are to be believed, which we have no reason to believe that housing is not one of their key priorities, that could be a really supportive backdrop actually for a house building company. Because if planning gets easier, mortgages become more affordable, it's easier to get land, it's easier to build, you've got the market there for the taking when we know that we have been structurally undersupplying houses for a number of years. And so this is one of the areas that we find both interesting growth opportunities in terms of a company like Bellway, which is, earnings are severely reduced versus previous highs, and we think that those could recover strongly, but also a company like Taylor Wimpey that pays out a fixed portion of its NAV every year, as a dividend, so really supportive to our dividend prospects, but where you could also get the kicker from earnings recovering as well. So on that note, I have less than a minute left, but plenty of time for questions. So fire away.
Thank you. Anybody questions for Anthony at all? Steve, this gentleman here, please. Thank you very much.
So, you touched on 3i. Have you looked at the reports that produced? What's your view? Is it opportunistic? Heard what they're trying to take out a punt and make money from it, or is there some evidence in there which you think supports it?
Yeah. So yesterday there was a report written by a short-selling house called Shadowfall, which made a few allegations. Now, normally when there's a short-selling report, what you're looking for is it a fraud? And this report does not say it's a fraud. And, this is not a sort of far away business that may or may not have a plantation that no one's ever been to. This is a real business. I've visited them in France, I've visited them in the Netherlands, I've spoken to companies that supply them, I've spoken to companies that don't supply them, that wish they supplied them. So, taking a step back, the first thing, is this a fraud? No, don't worry about that. What they have said are, one, the shares are quite expensive. I mean, that's their view. That's what makes a market. Half the people think it's a bit too expensive, half think it's a bit too cheap. That's where the price comes out. So I'm not too bothered about that. The report on that note specifically talks about some of the comparative companies and the ratings that they trade on. And it says that the peer group has derated, yet 3i has re-rated. Well, the peer group that it refers to is primarily the US discount retailers, so the Dollar Trees, Dollaramas, etc. And those companies have had horrendous profits warnings recently, whereas Action actually has been beating expectations. So I think saying that Action should trade on a lower rating as a result of that would be unfair. And Shadowfall don't reference, for example, Costco, that trades on about twice the rating that Action is valued at. So, I'll leave that aside. I'm not too bothered about that. The other things that they say are that Action has had a windfall to its margins through an inflationary environment. So if you think about a retailing business, the producer makes the product, the retailer buys that product off them, puts it in a warehouse, puts it in a store, and then eventually sells it to the customer. And so there's a period where that product is on the books at Action for a period of time. And for your average retailer, it will be 90 to 120 days from first contact to getting rid of the stock. Action actually has, and so what that means is, in an inflationary environment, if the price of the thing that you're buying over here is going up, then by the time you're selling it out here, you make a double margin on it, because it's gone up from A to B, and then you've put your retail price up from C to D, so you make double margin. Actually, Action holds their stock for far less, about 60 days, than any other retailer. So actually the impact would be less on Action than it would be on any other retailer. And also, Action has a policy of not letting margins go too high. Very similar to what Costco does as well, where what they want to do is be the most competitive place to buy these things. They don't want to bag extra margin, they want to take market share and put other people under pressure. So we're not too bothered about that element as well. At the margin, I could see how maybe that could cost them 10, 20, 30 basis points of margin. But that's in the context of a business that's growing its EBITDA at 25% a year. I'm not too bothered about that. And then the final point is they raise that the competitive environment in France has become more challenging. Maybe it has. It's competitive out there. France is about 10% of their new store openings. They're opening all over the place. There's still a lot of white space on the map. They haven't opened in the UK. I think they will eventually. They haven't opened in the US. I think they will eventually. So, France isn't the be-all and end-all, I don't think.
Okay, this gentleman here, please, Steve. Thank you very much. On the front row.
Anthony, there's a question about the shift into small caps and AIM, which you've taken from 2 to 15% of the fund.
Not quite as much as that. So small caps are 3% of the fund, and AIM is 1% of the fund.
Okay. But I mean, you put a bit more in small caps. You said you
Yes.
the FTSE 100. What is it that's pulled you towards them? Is it just valuation, or are you able to get exposure to more of the sort of tech and new economy companies that are listing in the top of the universe?
Yeah, so if you think about the shape of the UK equity market, about half of the index is the 10 biggest stocks at the top. But there are then hundreds of other companies that you can be looking at. And so our view is you shouldn't just go for the biggest ones because they're big and because, you have to hug the benchmark or whatever. There are really good opportunities more broadly across the market cap spectrum. They could be technology related. They could be, even just regular businesses that are taking market share. You just don't have to own the biggest companies because they're the biggest companies. If you go for a broader view of the market, and if you think about the team now in place, you've got Callum, who's been managing the fund for the last 6 years. I've come from a mid-cap background, although I've been an all-share investor since 2017. And Catan on the fund as well used to manage, or still does, manages the UK Smaller Companies Fund with Georgina Britton. We've got the breadth to look at every single opportunity in the market. And I think just adding more bandwidth to the team to look at more opportunities means that we've been less focused just on the biggest ones that may be the best known. It's just given us an opportunity to compare those more broadly across the equity market.
I mean, is there anything that particularly excites you?
There are 68 companies that really excite me. But
sorry, at that smaller end.
Well,
any acorns
take
that
a company.
really...
So I'll take one that we didn't used to own that we do now own, and I'll take XPS Pensions, which I touched on a moment earlier. So this is a pension consulting business, which sounds dull as dishwater, but it's a really, really interesting business. So a few years ago, there was essentially a CMA inquiry into the sector, and it said, look, you've got about 3 pension consultants who are doing all of the fund management advisory work, all of the de-risking strategy work, all of the actuarial work. And basically pension funds were going with one of them and then sticking with them for 10 years, 20 years, and giving them all of the work, and never actually shopping around to get the best price and therefore the best value for pensioners. XPS has basically merged together the number 4, 5, and 6, and as a result is now a true competitor to challenge that essentially an oligopoly. And so that, trustees are required to consider changing every few years. And so their share of flow, i.e. the tenders that they're winning, is higher than their share of stock, their existing market share. And that's just feeding through really nicely to just consistent market share gains. And it's capital-light business, it's a people business. They don't need to invest in a new machine or a new factory to be able to grow. They can just take on the work, hire new people, which means all that incremental cash flow that they generate comes back to us as shareholders. And that's why the dividend growth has been so strong, and I think will continue to be really strong.
Thank you, Anthony. Gentleman down there, please, Steve. Thanks.
Thank you. That's a very interesting presentation. My query is related to high technology stocks, related to space, genetics, biotechnology, etc. How much investment have you got in that, and how much are you planning to do in the future, in particular with regards to AI?
Yeah. So in terms of, well, I can take some of those head on. There are no, we only invest in UK listed companies. So for example, space, I think there's one company that supplies some products to Starlink, but it's too small really for us to look at. In terms of biotechnology, we are invested in some of the biggest pharmaceutical companies rather than sort of pre-profitability biotechs. But I think that actually is an area where AI is going to make a huge, huge difference. And I think it's going to actually favour some of those bigger companies. So someone like an AstraZeneca or a Glaxo, they've got a huge research budget. In the case of Glaxo, they've been misspending it for decades. In the case of AstraZeneca, they've actually got a pretty good track record for doing R&D. But AI is going to be really, really key to improving the drug discovery process. Because rather than having to go through the drawn-out process of, testing loads of different vials and seeing which ones have the right markers, and then animal trials, human trials, all this sort of thing, AI is going to help basically cut that process down in time massively. And so I think the rate of drug discovery and therefore growth from those companies, which we are invested in, could be quite material. In terms of technology, there aren't, again, a huge number of what you'd call necessarily traditional, mega cap software names. We don't have Microsoft listed in the UK. But what is interesting, I think, is some of the value-added resellers. So take a company like Bytes. They are a reseller of technology products, and they've been growing at a high teens cumulative growth rate for a number of years. And again, it's a capital-light business model, so all of that money comes back to us as shareholders as dividends. And they've also been really good at taking market share, because if you work for a company and you want to buy some technology, whether it's a Microsoft license, a cloud license, or even just some new computers to go on the desks, what you don't want to be doing is shopping around 10 different resellers, one for each product. What you want is one reseller who does it really well. And that's led to a huge amount of consolidation in the UK, organic consolidation, so market share gains for the likes of Softcat, the likes of Bytes, and some of the other value-added resellers that sit right up at the top. And as a result, we expect that growth to continue at very high levels. So that's kind of been the main way that we've had exposure to that theme.
Does everyone have a question there? Steve, Martin?
Very practical question. Net asset value
The net asset value
for you, per share.
per share. So I think in pounds million, Nick will probably know the answer better than me. I think the net asset value is about 430 million pounds. And on a per share basis, that's going to be, I should know because I bought some stock the other day. I'm not sure off the top of my head. Nick's your man, though. He's sat right behind you, and he's going to tell you if he can get on the internet. I don't know off the top of my head.
One final question here, please.
Okay, yeah, so you've actually given the case for the kind of dividend yield. But you haven't actually mentioned, again, it touches on that, you haven't actually mentioned anything about total return and share price.
Yep.
And whether the shares are trading at a discount or a premium to net asset value, which I think is leading there.
So at the moment,
again, usually you'd have a graph showing the share price and total return. You've shown the dividend yield.
Yeah. So I've only started managing this fund in the last couple of months, so I didn't necessarily want to talk to the historic track record of this fund in terms of sort of shareholder total return. But we are currently trading at about a 5.5% discount to net asset value. Clearly that enhances the dividend yield and the forward-looking total returns to shareholders going forwards. In terms of how we manage the trust, one of the important things that hopefully comes out of our focus on dividend growth is that we don't want to run this as a maximise your dividend yield today at the expense of actual relative performance. We're very focused on relative performance, and we think the way to deliver that is a combination of income and growth. And so, yes, that means the dividend yield, but it means also getting the companies that we think are underrated, like a Shell on 7 or 8 times earnings, as well as the companies that are going to deliver very strong growth into the future. And that's the only way, really, that you can find that initial dividend yield interesting, is if you believe it's going to grow and you can get some total return with it as well. So we are very much focused on total return we are measured internally on the total return, not on the dividend yield. But if we messed up the dividend yield, I suspect the board would have something to say.